City of Walnut, Diamond Bar area. Where in LA are you at?
I am by LACMA. So maybe
City of
yeah,
Walnut, okay. Diamond Bar. Sorry. Okay.
yeah. So maybe 10 minutes away from Beverly Hills. It's not that
Yeah.
far.
Okay. Well, you're not far. You're coming opposite direction, so you won't get traffic. It'll probably take you 35 minutes if you
Mm,
want to come out to our event on Friday.
okay. Diamond Bar.
Cool. Well, I know there's other people joining, but they're running late. So we're just going to go ahead and start. And first of all, I'd like to introduce myself. Yes.
Sorry, I'm going to yell at my kids really quick to be quiet.
Okay, go ahead. So my name is Annabelle Pacheco, and I am a real estate broker. I've been in business for like 20 years. And oh, he forgot to mute himself. You forgot to mute yourself, Sam.
Yelling at my kids. So my girlfriend moved in a few months ago, and we have 6 altogether now. So home office can be a challenge once in a while.
That's funny. That's good.
It's fun, but
hey,
it's
that's
great.
life, right? I mean, it's like you're making it work with kids, without kids. I mean, we have no choice.
Yep.
It is what it is. Cool. Well, congrats on that.
Thank you.
All right, let me start over. So thank you everyone for joining. This is Let's Talk Multifamily, and my name is Annabelle Pacheco. I have been a real estate broker for 20 plus years. I also am an investor, and currently, I represent clients in what is just a traditional purchase and sale. But a little bit of my background, I started in the mortgage industry. And then at that same time, I was rehab and flipping properties. And I did that for quite some time, have probably done over 100 homes throughout my career. And just learned how to learn that industry very well. What happened as time progressed, right? We get tired of having to flip one home at a time. I mean, don't get me wrong, it's a great business and I think the return is wonderful, but you're constantly having to start over again. And I was kind of ready for, you know what, I'm looking to get into multifamily. I want to do something that's going to allow this to appreciate over time. And it's not one door, it's multiple doors at the same time. And so my venture into the multifamily space started in Dallas, Texas. So as I mentioned, I live in California. I invest out of state. The numbers just don't make sense here in California for someone like myself. So I've had the experience of investing out of state, and one of the things that I did was actually purchase 34 doors, and I was able to get seller finance. I was able to go into this property, fix the property, update it, and increase its net operating income so that I can actually go out and get a traditional loan for it. And we did that. So I did a seller finance for 2 years, and my property had doubled in value by year 1. And so by year 2, I was in a very good position to pretty much just refinance, cash out, get all my money back, and have a performing asset. So it was a wonderful experience and a wonderful process, and really learned to love multifamily. And if we could just come across amazing deals like that, it would be awesome. And so I went full cycle. I ran the property for about 7 or 8 years, and then when the market hit, like we reached peak, sold the property, pretty much 5 times my money, and invested into another project that has, I mean, it's a commercial project, but was able to roll that money into an investment project. Along that, I've also invested with a couple of different syndicating or operators, friends of mine. And Sam is a friend of mine who's going to be our guest speaker today. And he runs the, he's a co-founder of the Multifamily Investment Club, which I love that name, by the way. And so I'm part of that
Thank
club.
you.
I'm part of that club, and I've invested in a couple of properties with Sam, and I'm invested in other properties as well. And I think, you know, the purpose for this call is really to bring value to individuals that are looking to get started into multifamily. You know, you may not want to do this on your own. Maybe you're looking to partner up with others. And this gives you an opportunity to meet me, meet Sam. If you have additional questions, well, we can definitely set something up and we can discuss. But that's a little bit about myself. Sam, if you'd like to share a little bit about yourself, and then we'll get into it. You know, we'll start talking about multifamily.
Awesome. First of all, congrats on that Dallas property. Every time we talk about it,
I
kind
know.
of gives me chills. That's
I know.
literally every investor's dream. So congrats. I don't think, you know, you give yourself enough credit, or maybe listeners, you know, I want to make sure they recognize how amazing that process was for you, and your results were phenomenal. So good job. But I'm assuming it was really easy the whole time.
That's what people think, right? I'm glad you brought that up, because the minute we closed escrow, everything fell apart. It was funny because my husband and I were there for the closing, and literally the next day the sewer just burst and backed up, and
Oh,
I mean,
wow.
like, it was just bad. And we're thinking the seller was holding this property up with like gum, you know,
Mhm.
like just hoping to God that we would close quick, so that
Yep.
if it was gonna happen, it was gonna happen on our terms, not his. And so, yes, it's hard. It's not easy, but you know what? You're in it.
But
And
you 5x'd your money.
the what?
You 5x'd your money, 5 times your money.
I 5x my money. Who
That's
can?
awesome.
It's gonna be hard. It's gonna be hard. So, but yeah, it was a great process.
No, that's awesome. And I wanted to point that out because there's really not much else that you can invest in that you can really compound your money that quickly with as little risk as real estate or multifamily provides. And a lot of really sophisticated, experienced investors say that multifamily is the most or the best risk adjusted returns you can possibly get, because you could go invest in a startup and 20x your money, right? But how many startups go belly up? What's the number? It's massive, huge amount of, you know, these angel investors or these investment firms lose a huge amount of money, but they're banking on one of those investments, you know, going just going gangbusters. And so I have the opposite type of mentality. I don't want to kind of base my investing strategy on a bunch of my money going to zero and then a few of them going really, really well. I would prefer to have something very, very even keel that's just going to increase slowly over time. In your case, you did actually a really big jump, but in the scope of things, you actually did an amazing investment in something that's actually pretty normal. It happens all the time. I would say yours is 5xing your money. You know, you timed it really, really well with the market going way up. You bought something that needed a lot of work. So when you combine those things, yeah, you're going to get some amazing returns. But there's no reason, you know, someone can't do something similar and get 10, 12, 13, 14, 15% per year. And you'll double your money in 3-4 years, 5 years. And so that's very, very possible. But that's the reason I'm in multifamily, is I don't have to worry about losing my money if I buy right, if I'm conservative. You know, I'm not just one of these investors who invest in all these different startups and I'm, you know, every other year I'm losing half my money. That's just crazy to me. I couldn't stomach that. I don't have that type of play money. One of my sayings is, you know, don't get rich quick, get rich for sure.
Right.
And so that's why I like multifamily. And it was funny. I hired a business coach and he did a couple personality tests on me when we first started. And he said, wow, he's like, I should probably invest with you, Sam. I'm like, why? And he goes, you have the lowest tolerance for risk of anyone I've tested. And I'm like, oh yeah, that's me. Yeah, I hate risk. I want to know exactly to a T what's going to happen, what are my worst case scenarios, and how to avoid any of those. And I've never lost money in real estate. You know, I was talking to a flipper here in Utah, and he's like, oh yeah, you flip long enough, you'll lose. You're gonna lose every year. You're gonna lose something. And I'm like, well, that's that's different, than I've ever experienced. I've never lost money, but I also don't do as many flips as he does. So I just can't stomach that. I always want to be able to at least make a decent return with as little as risk possible. And that's what multifamily does for you. So,
and I think that's important to also highlight is that, when you're looking to partner up with someone, you want to see characteristics, right? Like that of an individual. You don't want to hear that they're risk takers I get it that there is a certain level of risk involved, but it's somewhat of an educated and a calculated risk, right?
Mhm.
Not someone that's willing to just risk it all, right? To maybe you'll lose on this one, but you'll gain on this one. I like what he said, and it's just being pretty consistent and just fair right across the board.
yeah. And I think, if you learn how to underwrite multifamily, the underwriting principles of multifamily have not changed in 50, 60, 70, 80 years. They just don't. I mean, they're, maybe expenses will go up, loans will be a little bit different. We've learned that variable rate loans can crush you in the inflationary environment we've seen the last 3 years. Nobody had really seen that since the 80s, and nobody had seen that in my lifetime. I was born in the 80s. So, but really, you can hedge against just about anything that's going to happen if you have the correct underwriting principles. And so we've had some of the craziest things. We had a 40-year storm. You're in Cleveland with us, Annabelle, and we had remodeled half of a building, and we have about 500 doors in that area total. And the biggest storm in the last 40 years hit Christmas Eve a year ago, and really set us back a whole year of remodeling, and did some serious damage. And we know there's some operators in that market who did not survive. They did not have cash set aside. They did not have the right insurance policies. The storm just decimated them, and they're bankrupt. And so we're very, very lucky we are as conservative as we are. So there's all these different things that can happen. Interest rates tripling in the last 3 years. If you're trying to refi or sell in this market and you didn't have enough wiggle room, you are in big trouble. You can't sell for what you thought you could, and you definitely can't refi for what you thought you could. So, we've been able to, we've never lost a property. We've never lost money yet. So, we're very thankful for that. So there's a number of things that can happen. We're in a lawsuit right now with the property manager who stole money.
Wow.
One of our El Paso properties, theft and dishonesty. And so there's so many things that can go wrong. But again, if you look back at your underwriting principles, you can kind of plan for a lot of these things. You can plan for having money set aside to pay for attorneys. We had a line item in our underwriting that said attorney's fees in case we have to sue someone. We had money set aside. It's our rainy day fund or our slush fund, our oh crap, crap hits the fan fund of, and that was what got us through the storm in Cleveland, and we were able to pay for those repairs. So that's what I love. And one thing I did want to point out, not sure if everyone saw the news, but Charlie Munger did pass away, Warren Buffett's partner. And one of his quotes, which was just crazy to me, but it really, he said it to prove a point. He said, if you can't stomach 50% of your investments going to zero, or losing 50% of your investments in any given period, you should not be investing. And what he meant was, if you can't handle the ups and downs of investing, and you're going to lose your mind, or it's going to break the bank, having these investments go down that far, you should probably just have your money in something like a bank account or mutual fund, something like that, the index fund. So that was his point. And I've never seen real estate drop by 50%, anything I've owned, but it's a really good point. And there's just a lot of ups and downs that come with multifamily, come with investing. But again, what I love is you can plan for most of it, and you can set yourself up to be able to get through those ups and downs. And right now we're in some pretty big down times, and we're really struggling as a country, as investors across the country, with lower occupancy, higher expenses, less people moving in and out of apartments, people living with family. people not paying their rent. So there's a lot happening right now. And again, that was Charlie Munger's kind of main point, is you got to be able to withstand those ups and downs, especially the big downs. And that's also when Berkshire Hathaway made a huge amount of their money, in those recessions, and when everyone else was struggling, they loaned Goldman Sachs millions and millions of dollars and different things. So anyways, he had a lot of good points, but that was the one that really stuck with me from Charlie Munger, is talking about being able to be ready and withstand the downturns.
Oh, that's great. I mean, that's good. So let's talk a little bit about like the properties that you're running. I mean,
Yeah.
I want to share a little bit so that people get an idea of like how many properties, what's the portfolio number, and let's talk about those that have sold and what it's actually generated investors.
Yeah, great question. So we have about 500 doors in Cleveland. We haven't sold anything there yet. We're in the middle of remodeling the one that you're in. So we've got about 40 of the 75 doors remodeled. We're hoping to finish by next summer. We just finished a refi on the toughest, craziest remodel we've ever done, 187 doors.
Where at?
In Cleveland, next to the
Cleveland.
Cleveland Clinic.
Okay.
That's Fairmount 4. That's our fourth portfolio there. Really good location. That one was extremely challenging with inflation and prices going up, but we got it done. So anyways, we're in various modes of stabilization and finishing remodels across our portfolio in Cleveland. Got about 1,000 doors, or just over 1,000 doors in Texas, between San Antonio, Dallas, and El Paso. I would say my favorite market is El Paso. I did not expect that. I didn't know a whole lot about El Paso 5 years ago. And one of my coaches and one of my partners back then said, we got to check out El Paso. And it's been amazing. That's actually one of the markets where we're in a lawsuit with a property manager. They were dishonest and stole from us, yet we're still cash flowing. We're still doing very well. We're able to recover. The other property we have in El Paso, we just sent back $1 million to our investors. Extra distribution of money that we're able to accumulate through a cash out refi and a few other things that we did. So extra $1 million that we made this year in kind of a down market, which was a really, really fun thing to be able to do, be able to say, hey guys, here's your regular 6% cash flow we're sending you. The property's up $5 million in value. And by the way, here's an extra $1 million for everyone to obviously split based on their percentage. So
Yep.
that was really fun. And then we just sold 2 properties. We sold our Florida property and we sold our New Mexico property. And I would say they're probably the most similar properties to the one that you owned, Annabelle.
Oh, really?
Yeah. So, I mean, sewer pipes breaking. We had, I remember you talking about some of the residents weren't the cleanest in your property. We had some roach infested units.
Yeah.
We had drugs. I got I think one of the videos I did, it was about finding needles around the New Mexico property. Got 1.5 million views on TikTok, and everyone's like, well, what do you do as a landlord finding heroin needles all over the place? It's like, well, you do the best you can. And luckily it was other people, just vagrants walking through our property. It wasn't our tenants. But there's a lot of challenges that we faced, and I'm looking at kind of our distributions and basically the breakdown of what would happen if you were one of the investors in the New Mexico deal. And so we bought it October 2020. Let's say that you were an investor who put in $100,000 in that property. During the next 2 years from the time we bought it, you would have received cash flow about $31,000. And then when we sold it, you would have gotten your $100,000 back, plus an additional, let's see, an additional $35,000. So what that, what's that?
Plus the 31 that you collected.
Yeah. So what that came out to be was about a 20% per year return on your money. And that's not counting the tax write-offs that you got when we bought it, because there's some really significant tax write-offs. If you invested $100,000, I think on this one, you would have gotten about a $40,000 tax deduction through a K1. Now, of course, you have to recoup that when you sell, but most of our investors, when they received their cash from the sale of that one, they just put it into our next one, the Ogden deal, the Utah deal that we're doing right now, and they generate new tax write-offs. So overall, being able to have a property that has heroin addicts walking around, dumpster diving, we had sewer mains break, cash flow was not consistent. It was hard. And we actually had very big issues getting parts in, washers and dryers and refrigerators. There's supply chain issues. That was right during 2021. Huge supply chain issues. Our Florida property actually got shut down and dropped by our insurance because we couldn't get parts in. So a lot of challenges. And we had some investors that were pretty frustrated with the inconsistent cash flow, as were we. We had hoped to cash flow consistently, and it just didn't happen. At the end of the day, though, I was able to call every investor when we sold and say, congrats, you averaged 20% on your money each year that you owned this property with us. That's really, really hard to do. And that was one of the funnest phone calls I've ever made as a syndicator, as an operator. And then we did the exact same thing with the Florida property. That one was rough, inconsistent, huge challenges. We had a hurricane that we had to repair after. And still, we averaged about 21% on people's money. And it was very, very similar to your property, Annabelle. I would say rough tenants. As soon as we bought it, things broke that we weren't planning on. And yet we pulled through and were able to sell for some really great returns. And so it's been a really challenging last 12 months across our portfolio, across the country. And yet, because we bought really well, really conservatively, we're able to see some really amazing returns for our investors, and it's been a lot of fun.
20%, that's great.
Yeah, and we actually had an investor say, "Oh, that's pretty good," and I was like, "No, it's actually really good." Do you know what the stock market did? If you were in an index fund or if you had, so I had a few examples lined out. I wish I had it in front of me right now. But I said, if you had invested in this type of investment, this is what you would have made. And so we're beating most other investments by double, to be honest. And that's nothing that we've done other than be conservative, good operators. It just speaks to multifamily and the power in buying value add multifamily and doing it the right way.
Yep, I agree. Are you currently investing? Like, are you guys looking to buy right now?
Always, yeah. We just bought one in Utah, the one I was talking to you about on the phone. Okay. We're about to send out to a few people. We didn't try to raise too much money for it because we had these investors coming out of the two deals that we reserved most of the space for in that deal. We've got a few $100,000 left to raise on that one. That one's identical. 30 units, really rough shape. But we bought it because it was a really good opportunity. The guy that owned it ran it in the ground. And so when we closed on it, and we've already closed on it, there was one tenant left out of 30 that he was evicting because they hadn't been paying. And so he basically had just let really bad tenants move in, and then they wouldn't pay and didn't know what he was doing, took months and months to evict. So it's vacant right now, and we're actually just starting it's to remodel, and the city's really excited about it because they've had crime issues with it and vagrants and just the typical really property that we've done very well with over the last 5-6 years, which is beat up, kind of small, in a really good location. Though someone else ran it into the ground, or as you said, they're holding it together with toothpick and gum, just hoping to close on it before more stuff goes wrong. And so we're really excited. We bought it for less than he paid for it, which was interesting. And so, and it's interesting that he ran it into the ground as bad as he did, because for us, the last couple of years have been pretty easy to do well, if you just do a good job managing your properties. And so what that speaks to is there's always opportunity in every market. There's always people doing a bad job. There's always people passing away. There's always people getting divorced. There's always people that have these life crises that create opportunity for someone that's willing to come in and do the hard work.
And are these in Cleveland? Is this one in Cleveland or Texas?
Actually, our first property in Utah. I couldn't afford to buy in Utah for a very long time until we found this opportunity. So I'm really excited to be able to play in my backyard here and get a project done here.
So are you focused, I mean, like what areas are you focusing in as far as investing? Are you staying in like your Cleveland, El Paso, the areas that you're currently invested in, or are you open to other areas?
Yeah, that's a really good question. So I love Utah because of the economics here. We don't get as hit as hard during downturns. Really, really good employment base. Multiple different companies and industries here in Utah. It's been hard to afford to buy anything here. What we do love is Texas, landlord friendly, really good growth as well. We do like Cleveland. I feel like prices have inflated there enough to where we probably won't buy there for a while unless we can get a screaming deal. And what we also did is an analysis across the board of everything we owned. And what we said is we probably can't afford to buy in Florida because of the hurricane insurance inflated. And across the country, insurance has doubled and tripled. I'm sure you've heard of that. And so that's made it very, very difficult in markets where insurance is already more expensive, like Florida, because of hurricanes. We love Florida. We absolutely love the economics. It's landlord friendly, and a huge amount of people are moving there, which is what we really like. That's what we look at. Texas, very landlord friendly, huge amount of people moving there, companies moving there. We love Dallas, love San Antonio, love El Paso, would love Austin, but we haven't been able to afford to buy anything there yet. So that's really what we're looking at is where have we been able to do very well, but also where the expenses not rising as fast. So that would be Texas, Utah, Florida is still pretty darn good. Cleveland, though, based on what you can buy there and how expensive those older units are to manage, especially when those storms hit on Christmas Eve. Things like that. We're probably going to stay out of Cleveland unless we can get an absolutely crazy deal like we did on the ones that we bought, a couple of years ago. Those were crazy cheap deals, $70,000 a door. You just can't do that now. Prices are up to 95, 100, 105,000 a door, and that just is cost prohibitive for us.
I mean, I'm getting a couple properties. Not I'm purchasing, but like I get listings of properties in Texas, and they're $120, $120,000 a door.
Yeah.
I'm like, this
and
is
even more if it's Class B. We bought. I want to say we paid about $115 a door. I mean, we're getting sent deals right now where it's 160, 170, 180 a door, and I'm just like, with rates where they are. I mean, that's why there's been a huge slowdown, like 30% slowdown in the market, because buyers just can't afford to buy. And who knows, maybe seller financing will come into play. There's a lot of loan assumptions happening.
I do see that.
And I know a lot of the really good deals aren't even hitting the market. A lot of those institutional type huge buyers are seeing those deals first. I have a couple friends that, they see deals that I'll never see because they own 5,000 doors, 8,000 doors, and they can close on it, very quickly. And so we're definitely still looking, but it's hard. It's hard with these rates. I know they did just, there's been a lot of news about rates coming down or potentially coming down. I just posted something on my Facebook. A lot of people are thinking, maybe March to June to July rates may come down, but I don't think they're going to come down a whole lot. And what I've seen is there's a lot of sellers needing to sell and a lot of variable rate loans or loans coming due. And so that's what we're watching for as well, is maybe operators that are in a little bit of trouble that really have to sell. Maybe not as big properties. What I really like is the $25 to $35 million price point, because the bigger the scale, they're so much easier to run. But a lot of those properties go straight to the institutional buyers. And so I had told a lot of our investors, we're kind of out of the 30 to 50 unit game. It's the same amount of work for a lot less profit, but they're a little bit less competitive than those bigger ones that those institutional buyers just scoop up. So we may be in the market for some of those. And honestly, when we looked at our numbers, Annabelle, our highest profits have been with the 30 to 50 unit size deals. Averaging 20% a year is hard to say no to. So we'll probably be doing some more deals like that.
Yeah. Well, okay, that's good. Let me know on that. So what are your thoughts? I don't know if you remember, like I'd say the last 2 to 3 years, there was a lot of operators that were purchasing Class A, like tons.
Yeah.
I mean,
Yeah.
like going insane, paying top dollars. What do
Yep.
you think is happening right now?
Well, there's the guy in Houston who lost $250 million portfolio. He lost over $100 million of his investors' money. So there's things like that happening. There's Grant Cardone, who really only purchased A class units, and he's told everyone, hey, the reality of this market is that portfolio is down. It's not really cash flowing right now. Luxury is the first thing to go. And that's why we've never been into A class luxury. We'll do A class, if it's not high end luxury, because who doesn't want a brand new unit? But what rents out really, really well is the B class and the C class, and our occupancy, I think the reports we got yesterday on our Dallas property were at 95, trending in 96% occupancy. It struggled for a few months this year, but we're back up. We did have to lower rents a little bit, but I don't know. I would say there's a lot of people struggling. I would never be an A class luxury because unless you can buy it for an amazing deal, unless you can get just a killer deal on it. But you do have to realize that luxury is the first thing to go when the market tightens up.
Mm-hmm. What do you see now? You talk to a lot of investors. What do you see, or what's that trait that you see in the investors that actually work with you versus those that don't even pull the trigger? What's that trait? What is it there that you see in those investors?
Yeah, I think I'm in sales as well. I still sell real estate and I sell a lot of investment properties. That's primarily what I've done here in Utah and Boise. I've got a duplex for sale in Boise right now. And I think education and actually understanding, and this is what I've pitched to my investor clients and actually people like you as well that invest with me in syndication, is let's figure out together what your investment strategy is and what you feel comfortable with. And then let's educate you a little bit more on that and let's run the numbers, because I can tell you what I like and what I like to invest in. And Grant Cardone can say, no, I only buy A class luxury because I don't want to have to remodel anything. And I want to get these 10-year interest only loans. And so there are huge advantages to doing A class properties. I just don't prefer to invest in them. And so what I tell my investors and my clients is, let's figure out what your investment strategy is. Let's figure out what your risk tolerance is, how much you're looking to invest, what your goals are. Do you want cash flow, or do you want appreciation, or do you want to mix sure the two? And let's dial that in really well for you so that you feel comfortable being able to make a decision. Because a lot of investors come to me and they really don't know what they want. They just know they want to invest. And once you really hone that in and you figure it out, you put it on paper, then you're able to make a decision and say, yeah, that's the type of investment I want. I want that property in El Paso because I want medium appreciation with decent cash flow, and I want really low risk. Mm-hmm. And I want to be in a landlord friendly state. And I want, so if you can just go down the list of exactly what you want, then you can really understand when these deals come by your desk or, hit your email, if it's something you're interested in or not.
Which makes sense. And I think, you've shared a lot of information right now, and I just want to ask if there's any question, anyone on this call have any questions up until now, because it is a lot of info. Any questions? You guys all get it? We're good?
No problem. They can always email me as well if you think of any questions.
Why don't you put your email on the chat and
advice on investing in Toledo, Ohio. Let me put my email really quick.
Yeah. What's your advice on investing in Toledo, Ohio?
So I did an Ohio tour with my business partner, Lyndon, because I wanted to know we were looking at Columbus. We have 500 doors in Cleveland. We were being pitched. Oh, I guess we have 400 doors in Cincinnati. I forgot about Cincinnati. We looked at Dayton. Stay away from Dayton. There's
Okay.
just huge amount of just vacancy there that they don't tell you about. It's a declining market for sure. I don't know Toledo well enough. I would say, it's in between Cleveland and Detroit. Toledo, I don't know the metrics. What I would want to know about Toledo is that market increasing or decreasing? Cleveland hasn't changed. It's been about 2 million people for like 50 years, and we are in a part of Cleveland that's next to the number 2 hospital in the world. And so the demographics for us are phenomenal. Our average income for our residents is 70,000. Our average credit score is 740. That's better than my neighborhood I live in. That it's a really, really, because they're doctors, they're nurses, they're hospital workers, and it's soon to be size-wise the number 1 hospital in the world. So that's why we invested it in Cleveland, because that huge anchor, and that's not going away. That's really not going away. So I would say in Toledo, what do you have? What kind of companies do you have that are bringing in jobs? Are the jobs increasing? Are they decreasing? And so that's what I would look at. And what is your average income for that area? There's parts of Cleveland where, we were being pitched deals that were, 40, 50,000 a door for purchase price. And that's great. But the average income for the area was like 25,000, and they just couldn't afford the rent. If we were to increase rent, they just wouldn't be able to afford it. And so those deals did not make sense. Same thing in Atlanta. When we were looking at some deals there, they looked good, and until we did the research and the value add, that there just wasn't an actual potential for any value add in that area. So I would look at your average income per area. For the area you're looking at, I would look at your jobs and what type of companies you'd be close to, and things like that. And so instead of giving advice on areas, except for Dayton, I literally almost got carjacked in Dayton, and
wow.
and drove around downtown hoping to have like a cool downtown experience, and it's dead. It's half of downtown Dayton is just vacant. And so, if you were to look at those metrics, I'm guessing you would find a huge amount of vacancy and a negative net migration in Dayton is what I'm guessing. I haven't looked since then, but there's areas that you just want to stay away from, because if you're having issues with vacancy and jobs, and you're just not going to be able to operate a multifamily property very well.
Well, at least we now know not to go into Dayton. Thanks.
Yep, learn the hard way. But no, and there's so many resources. You can find a broker and you can get those statistics through CoStar, City Feet. Those numbers are so easily obtainable. There's no reason to go, drive like we did, but we wanted to see the areas. We love Columbus. We love to buy in Columbus. We love Cleveland, close to the Cleveland Clinic. Our Cincinnati property is doing very, very well. There's like 3 hospitals within 20 minutes of our Cincinnati property. So, there's some really great parts of Ohio.
How far is Dayton from Cleveland?
Oh, it's closer to Cincinnati, and it's in
Okay.
between Cincinnati and Columbus. But you're like 45 minutes from Cincinnati, 45 minutes from Columbus.
Okay. Wow. All right. Very good. Let's see what else. I think I'm running out of questions for you.
Yeah, I would just say last piece of advice is there's some really great underwriting softwares that, like Michael Blanc's, you can pay, I forget what he charges, $100, $200 for his software. And there's free tutorials on YouTube. You can really learn how to underwrite a property. And, we have our own custom one that our head underwriter built from scratch. But really understanding the numbers and why those numbers make sense for the properties that cash flow. And that's what I would learn. That's really, really important, at least being familiar with it and understanding the principles behind what does a good underwriter look at. Because then when you get sent these deals, you can say, well, what is your assumption for vacancy? If they're assuming 1% vacancy, they're fudging the numbers. If they're assuming 10, 15% vacancy, okay, that's a conservative looking deal. What are you assuming for bad debt? What are you assuming for, repairs and maintenance or advertising? And if you're able to ask those questions and look at someone's underwriting, that makes you a very educated investor in someone. And it doesn't take a lot of time. You can do it over a few months. You can spend a half hour a night or 15 minutes a night just watching these YouTubes and understanding it. And those are the people that really go far in this industry, I would say, that actually understand the numbers.
Thank you for sharing that. Are you able to type his name in on the chat?
Yeah,
That'd be great. I mean, I think that is key, right? Underwriting, if you have a good grasp of how to underwrite a deal, when someone presents you with an opportunity, you now can take those necessary steps on your own, right? To figure out and see if these numbers really do make sense.
Exactly. And I can send you example deals that we've done so you can look at the underwriting, look at our actual performance. I'm happy to do that for our investors as well, for those that want to educate yourself a little bit more.
That's great. I'd love that. Can you do that? Can you send me one?
Yeah, I'll send you my favorite one, the El Paso deal.
Thank God I invested in that one.
Yes. Oh, I forgot you're in that one. Yeah, that's right.
Yeah, I am.
Yeah. That's my favorite deal. It's funny because I was so intimidated. It was a $27 million purchase. And I was like, how am I going to raise $11 million? I had just raised $7 million and $4 million for other deals. I was like, how the heck am but I have to buy this property. It was like a little golden nugget that we found. We got it done, and it's been just the best deal we've ever purchased. And so I just want more. It's called Terrace Hill. I just want more Terrace Hills.
I know. Like, I want more of mine.
Yeah.
I want Terrace Hills and Grand Prairie. So
exactly.
Yes, I want more of those. That's cool. All right. So everyone, I mean, if you guys want to take a note of the underwriting software,
Yeah, put the link there.
Yeah, the link is there.
I have a question. Can you hear me all right?
Sure.
Yes.
Yeah, okay. For your investors, like how and when are you looking for them? Like if, for example, I was looking to invest with you, like is it possible at any moment? Do you have like a minimum amount? And like how do you proceed?
Yeah, we typically have a 50,000 minimum. I don't have deals all of the time, and I'm not a fund. So typically a fund you can invest at any time, and they'll have 3, 4, 5, 10 deals a year, and you invest in the fund, and then they invest your money throughout the year. I'm a syndicator, which means I find a deal, I email everyone on my email list and say, okay, we've got a deal. We need to raise $11 million, first come, first serve. And that's how it goes. Right now, we've got one deal that we're raising money for that we can send you the info on. And we've got a little bit of room left in that. But typically, our deals, you have to be an accredited investor, which means you make $200,000 a year or you have $1 million in assets. There's been just a couple deals that I've done, and this is all based on SEC regulation. And there's reasons to do accredited versus non-accredited. This deal that I'm doing right now is non-accredited. And so we actually can't advertise it. We can't throw it out on the internet. Just past investors or people I already know can invest in that deal, people that I've met previously. And so we've got that deal right now. And so there's a lot to being a passive investor, and that's probably a longer conversation. Happy to talk to you more about it and what things to look for. But basically the SEC says, okay, if you make a certain amount of money, you can understand investments. Mm-hmm. If you make less than that amount, there needs to be a longer process of you learning about investments with that syndicator before we'll allow you to invest with them. And so that's kind of the difference there. But happy to email you, or you've got my email right there in the chat. Yeah. Happy to respond and send you the details and educate you a little bit more.
Sounds good. Thank you.
I've got to run, Annabelle. I've got to get my 6-year-old to the orthodontist.
Yes, thank you.
Thank you
very much. This was great. Good, valuable information, and it's always great you know, to hear
And
from
sorry
you.
for yelling at my kids at the beginning.
It's okay. No worries. Thank you. Let me see. I think we have one more message. Oh, no, that's it. All right. Thank you guys. Have a wonderful week. And if anyone is in the LA area and wants to join Agents Helping Agents, it's this Friday in Diamond Bar at the Holiday Inn. And I think, Patricia, you saw that. So feel free. Maribel, Lumel, thank you so much. And thank you so much, Sam. I'll
Thanks,
see you.
Annabelle. Appreciate you. Thanks, guys. Take care.
Bye.